This is a personal finance what if, because it starts with one person's education decision, one person's money, and one person's long-term trade-off. In August of 2026, two 18-year-olds stand in the same kitchen, staring at two very different futures. Maya is packing for college, twin Excel sheets, a used laptop, a financial aid letter with numbers that somehow look both official and terrifying. Her school's published cost is about $28,000 a year for in-state tuition, fees, room, and board. After grants and part-time work, her family expects she'll borrow and pay roughly $20,000 a year out of pocket. Across town, her friend Jordan is looking at the same kind of acceptance letter and doing something most people would call reckless. He's not going. Instead, Jordan takes the money his family had set aside for college, $20,000 a year for 4 years, and puts it into a broad stock market index fund. He gets a job, starts learning skills online, and tells everyone, "I'm investing the tuition." At 18, Maya gets the degree. Jordan gets the portfolio. So, 20 years later, who's actually ahead? The part nobody explains clearly is that college is not just an expense. It's also an investment. But unlike buying an index fund, the return is messy. It depends on your major, your school, your debt, whether you graduate, what kind of job market you enter, whether you use the degree in a high-paying field, or whether you spend 4 years and $80,000 just to end up in a job that didn't require it. The stock market is messy too, but in a different way. If Jordan invests $20,000 a year for 4 years, he has put in $80,000 total. If that money earns an average of 7% a year after inflation, close to the long-term real return of US stocks, then time becomes his superpower. Money invested at 18 gets more years to compound than money invested at 30, 40, or 50, but Maya is investing too. Just not in an account. She is investing in higher future earnings. According to the U.S. Bureau of Labor Statistics, in 2024, the median weekly earnings for someone with a bachelor's degree were about $1,543. For someone with only a high school diploma, it was about $930. That's a gap of $613 a week, or nearly $32,000 a year. On paper, that looks like Maya wins easily. But paper is not life. Let's put real numbers on both paths. Maya attends a public university from age 18 to 22. She pays $20,000 a year in net costs, so her total college cost is $80,000. To keep the comparison simple, assume her family covers half and she graduates with $40,000 in student loans. That's not extreme. In the US, the average federal student loan debt for bachelor's degree recipients who borrow is often in the range of $30,000 to $40,000, depending on the year and data set. So Maya is not doing something wild. She's doing something normal. While she's in school, she works summers and part-time jobs, but doesn't save much. At 22, she starts a job paying $60,000 a year, not Silicon Valley money, not Wall Street money, just a solid early career salary for a college graduate. Jordan skips college and starts working immediately at 18. His first job pays $38,000 a year. He lives at home for 2 years, takes online courses, and invests the $20,000 a year his family would have spent on college. By age 22, he has invested $80,000. Now here's the strange thing. At age 22, Jordan looks richer. If his investments earned 7% annually, his first $20,000 contribution at 18 has already grown for 4 years. His total portfolio at 22 is around $92,000. Maya, meanwhile, has a degree, a new job, and negative net worth because of her $40,000 loan. Jordan has money. Maya has earning power. And this is where the whole debate usually gets lazy. People say, college is always worth it, or college is a scam, as if every degree and every career are the same. They are not. The Federal Reserve Bank of New York has estimated that the average return on a bachelor's degree has historically been around 14%, meaning college has often paid off better than many traditional investments. But that is an average. Some degrees produce huge wage premiums. Others produce much smaller ones. Engineering, computer science, nursing, accounting, and economics tend to have strong earnings outcomes. Some lower-paying fields can still be meaningful and socially valuable, but the financial return may take longer to show up. So Maya's degree is not magic, it is a lever. And a lever only helps if it's attached to something that moves. By age 25, Maya is earning $70,000. Jordan is earning $48,000. He has work experience, a strong portfolio, and no loans. But the income gap is opening. Maya pays $450 a month toward her student loans. Jordan invests $500 a month on top of the original tuition money. Maya can't invest as much yet because her cash flow is tighter. This is the hidden cost of borrowing. It doesn't just reduce your wealth today, it delays your investing tomorrow. At 25, Jordan's portfolio is roughly $130,000. Maya's net worth is still close to zero. Jordan is ahead, but only on the scoreboard we can see. By their late 20s, something changes. Maya's income starts climbing faster. She moves from $70,000 to $82,000, then $95,000. Her degree gets her through automated filters. It qualifies her for promotions. It lets her switch companies without starting over. Jordan is talented, but he keeps hitting invisible walls. Some jobs say, bachelor's degree required, even when the actual work could be learned elsewhere. That degree requirement may be loosening in some industries, but it has not disappeared. In 2023 and 2024, several large employers and state governments talked about dropping degree requirements for certain roles. Maryland, Pennsylvania, Utah, and others announced skills-based hiring reforms. But the labor market did not instantly become a pure meritocracy. A 2024 report from the Burning Glass Institute and Harvard Business School found that many companies removed degree requirements from job postings, but actual hiring patterns changed much more slowly than the headlines suggested. That is the twist. Skipping college can work brilliantly if Jordan finds a field where proof of skill matters more than credentials. Sales, trades, coding, entrepreneurship, design, real estate, certain parts of media and marketing. But if he enters a credential-heavy world, the missing degree becomes a tax on his options. At age 30, Maya has paid off most of her student loans. Her salary is now $105,000. Jordan is earning $65,000, which is respectable. His portfolio, with continued investing, is around $250,000. He is still ahead in net worth. Maya looks at that number and does something counterintuitive. She stops trying to catch up all at once. Instead of panicking, she raises her savings rate every time her income rises. Her loans are nearly gone, so the old loan payment becomes an investment contribution. She starts investing $1,500 a month at age 30. This is where the race changes. Jordan had the early start. Maya now has the larger shovel. From age 30 to 40, Jordan continues investing $500 a month. His income grows to $80,000. He's done well. No debt, no degree, a strong work history, and a portfolio built from the money most people would have spent before they even got their first full-time job. If he keeps earning 7% a year, his portfolio at 40 is roughly $770,000. That is the power of skipping a major expense and investing early. But Maya's path starts compounding too. At age 30, she has little invested compared with Jordan, but from 30 to 40, she invests $1,500 a month. Her income climbs from $105,000 to $145,000. That's not guaranteed, but it lines up with the broad reality that college graduates tend to earn more over time. The Georgetown University Center on Education and the Workforce has estimated that over a lifetime, bachelor's degree holders earn about $2.8 million, compared with about $1.6 million for workers with only a high school diploma. That's a difference of roughly $1.2 million over a career. Again, not for everyone. But across millions of workers, the premium is real. By age 40, Maya's portfolio is around $310,000. She is behind Jordan in investments, but her annual income is much higher. And if you measure total net worth, including the value of her higher earnings, the gap is no longer simple. Now fast forward to age 50. Jordan's original tuition investment has had 32 years to grow. The $80,000 he invested between ages 18 and 21 could be worth about $690,000 by itself at 7% annual growth. Add his $500 monthly contributions from age 22 onward, and his portfolio lands around $1.45 million. That's extraordinary. Maya, starting serious investing later, still catches a lot of ground because her higher income allows bigger contributions. If she invests $1,500 a month from 30 to 40, then $2,500 a month from 40 to 50 as her salary grows, her portfolio reaches roughly $1.1 million. Jordan is still ahead in portfolio value, but Maya has earned more along the way. Over those 28 working years, from age 22 to 50, Maya may have earned around $3 million before taxes. Jordan may have earned around $2 million. That extra million in gross income paid for loans, housing, taxes, lifestyle, family needs, and investments. It may also have bought more job security, better benefits, and access to roles that would have been harder without the degree. So who won? The honest answer is, it depends on the missing details. If Maya chose a high-cost private college, borrowed $160,000, and entered a low-paying field, Jordan probably wins financially. The investment account may beat the degree. If Jordan invested the tuition but then stopped learning, stayed in low-wage work, or sold during a market crash, Maya probably wins. If Maya graduated into a strong field with manageable debt, the degree likely pays off. If Jordan entered a high-income trade, built a business, or learned scarce technical skills, skipping college could be a financial superpower. The real comparison is not college versus investing. It is delayed earning power versus early compounding. College says, give up money and time now and maybe earn more later. Investing the tuition says, keep the money now and let time do the work. Both can be brilliant, both can fail. The worst version of college is paying premium prices without a plan. The worst version of skipping college is avoiding tuition, but never building valuable skills. So if this were your choice, the question is not, is college worth it? The better question is, what return am I actually buying? If a degree costs $30,000 and opens the door to a career paying $20,000 more per year, that's a very different investment from a $200,000 degree with unclear earnings power. And if skipping college lets you invest $80,000 by age 22, that's powerful, but only if you also build skills that raise your income. Money rewards time. Careers reward capability. The dream scenario is not Maya or Jordan. It's combining both ideas. Keep education costs low, avoid unnecessary debt, choose skills with real market value, and start investing as early as possible. Because the biggest mistake is not choosing college or skipping it. The biggest mistake is doing either one without knowing what game you're playing. What if you skipped college and invested the tuition? The answer isn't that college is always worth it or always a waste. It's that time in the market is powerful, but so is building skills that increase your earning power. If you found this useful, subscribe to What If Finance. New video every week.